Hello, everyone. Welcome back to Signal or Noise, episode 61. Charlie Bilello here, and with me, as always, my co-host, Peter Mallouk. Peter, great topic for today. 10 charts every investor should frame. Let's get right to it here, starting with the first topic here, the power of compounding. And no one really said it better than Charlie Munger when he said, the first rule of compounding is to never interrupt it unnecessarily. And here's the chart illustrating that. You look at the last 10 years, been a great 10 years for the U.S. equity market, up over 15% per year. But if you got out in March 2020, and as you know, Peter, many did, that was the biggest outflows we saw in the history of mutual funds and ETFs, your return would only be about 2.5% per year.
There's a lot of risks when it comes to investing. The single biggest risk is exiting the market. And a lot of people perceive being in the market as risky. Being out of it is much, much more risky. If you're in the market and the market goes down, that's a temporary moment in time. It might go on for a day. It might go on for 2 years, but it will eventually recover. If you instead go out, the market can go up, get away from you. You may never revisit the lows, and that results in permanent loss. One of the number one things an investor can learn is once you've got a plan, once you're in the game, stick with it. Stick with it for the long run.
Yeah, and this chart really illustrates that concept of you may not have a second chance here. We just pretty much went vertical off of those lows in March 2020 and never looked back. Let's talk about Munger's partner here, Warren Buffett. My life has been a product of compound interest. And here's the crazy stat, Peter. I want your take on this. Warren Buffett was a rich man at age 65. He was doing pretty well, $3 billion in net worth. But he just turned 95 this year. And when he did, his net worth was $150 billion. So that means over 98% of his current net worth came after the age of 65, when most people are thinking about retirement.
This is a really powerful illustration of compounding and the power of longevity. Like, we have more and more Americans living longer. I've got a lot of clients, I've been at this now almost 25 years, that when I started with them, they were retiring, they had a few $1,000,000, and today they have $8-9 million because they're in their 80s and early 90s. And the power of compounding has completely taken over. And Warren Buffett's a great example of that. Now, a lot of people go, well, he's crushing the market. No, not really. Generally, I think over the last decade, just almost about exactly what the market is.
Yep, even 20 years. Yep.
Yeah, even 20. Okay, so even 20 years, what the market is. This is just showing the power of leaving money in play for a long period of time. You could take that, his $3 billion, show 150, but you could show somebody with $1 million and see why they'd have a lot more money today as well.
Yeah, and I think this is a big reason why creative planning, and I know you're a big believer in this, we're not following that formula of putting your age in bonds in terms of the allocation. And Buffett would not have experienced this compounding if he didn't have all his money in the equities market, right?
It's 100% correct. I think, like, a lot of people say, oh, this is your risk tolerance. You're going to get this much in bonds, or you're 70, you're going to be 70% in bonds. Bonds barely keep pace with inflation. You've got to be in stocks to stay ahead of inflation. And over the long run, you get the compounding effect of dividends, growing earnings, and the inflationary effect, which is a very substantive part of what drives markets.
Yeah, and as you said, with people living longer, their portfolios going to need to last longer. It makes more sense to have a higher allocation to the equity market. Let's go to the price of admission. There is a cost to investing. There is a reason why you're getting that higher return than a risk-free treasury bill. And that's because, as Peter Lynch said, you get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. And there's a bear market coming, Peter. I know we had one earlier this year. It felt like a very quick one. It was a very quick one. But you and I know there's another one coming. Just looking at this chart, there's no rhyme or reason to when they happen. But it's coming. We know it's coming, and you should be prepared for that. If you're not, you really can't be an equity market investor, can you?
Yeah, you just have to embrace them. I mean, if when we were going through the election campaign, no one anticipated that the first thing that would happen when Trump took office was a bear market that was self-imposed by having a tariff war. No one would have guessed uh, over 5 years ago, going into the year, that we would have a global pandemic and a shutdown that went on, a long period of time. No one was predicting the terror event that drove a bear market. I mean, time and time and time again, something that's on no one's bingo card coming into the year is what creates the bear market, and they happen all the time. No rhyme or reason, like you said, like 9/11, the tech bubble, just boom, back to back. We went from 08, 09 to more than a decade before having one. They don't evenly space them out. No one gives a warning. No one rings a bell. But like Peter Lynch said, you just got to accept that it's a normal part of the show, or you shouldn't be in the game.
Yeah, and you can't have the blue in this chart, which is I'm showing you the bull markets, which last longer and compound cumulatively more than the losses in bear markets. You can't have that. They last 5 years on average, 250% without taking that occasional bear market happens every 4 or 5 years on average. But as we've seen the past 7 years, you can have a few in a short period of time, and we've seen that. So average of 30%, they could be bigger, as we'll talk about in a little bit here with Charlie Munger's quote, if you're not willing to react with equanimity to a market price decline of 50% 2 or 3 times a century, you're not fit to be a common shareholder and you deserve the mediocre result that you're going to get. Charlie Munger, never afraid to speak his mind. And really, he lived this, Peter, because everyone talks about Berkshire Hathaway and the amazing returns that they've had during their lifetime. But there's some big drawdowns along the way. I'm highlighting just two here in Berkshire Hathaway's Class A shares. You had almost 50% drawdown in the late 1990s up to 2000, and another over 50% drawdown during the global financial crisis. So, yes, you've seen a huge appreciation in these shares, but they had to react unemotionally to these huge drawdowns in order to experience these enormous long term gains. And every investor should appreciate that this is a possibility if you're looking out long enough. If you're going to invest 20, 30, 40 years, you could very well have another 50% decline.
Yeah, you're a great investor when in a massive drawdown you get excited because your dividends are being reinvested at lower prices and you see opportunity to maybe sell some bonds, buy some stocks, have your new dollars in your 401k buying the market at a discount. And this Buffett got pretty excited about the opportunities all around him in 08, 09. If you can shift your mindset to that, go from being scared during a bear market to feeling like it's in a land of opportunity, then you've got the right mindset for the next 20, 30 years.
And here's Peter Lynch saying far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. And to illustrate that, Peter, this is one of my favorite charts, just showing you intra-year drawdowns for the S&P 500 going back to 1980. And the average year actually sees a 14% drawdown. We had an even bigger one this year at 19%. If you just looked at the year-to-date return for the S&P, it's up 16%. You say, how is that possible? Well, there's downside every single year, but overall, the market during this period of time is actually compounded at 12% per year. So you really have to accept that each and every year there's going to be some risk. And I think Peter Lynch really said it well here.
Yeah, I mean, I think this really blows people away that a normal year, there will be a drop from the top somewhere along the course of the year of 14%. I mean, that's really, think about that from today, right? You're talking about 6,000 point drop would be something that happens every single year. If it started today and the year ended with that, I mean, everyone would be completely freaking out. We just react to it very negatively every time, particularly if they go on for more than a few weeks, but they happen every single year. You just it's great to get educated about it because then you learn to just shrug your shoulders a little more.
Yeah, and the part he's talking about though, Peter, is of course you would love to avoid that 14%
Yeah.
drawdown, but what he's saying is by trying to avoid it, as we talked about in the 2020 example, let's say you even sold right before that big drop in 2020. Were you going to get back in then after the market recovered and continue to run huge amounts thereafter? Probably not. So what he's saying is even if you're able to sidestep it, which we know no one's been able to do that repeatedly over the course of many market cycles, you're likely to still miss out on the upside because you probably won't get back into the market at the right time. Okay. Staying the course here, important concept for investors. We'll go to Peter Lynch again. The key to making money in stocks is not to get scared out of them. And there's been a lot of talk, of course, about the Mag 7 and what I call the enormous 8. I've added Netflix into that group. And you look at NVIDIA, 30,000% return over the last 10 years, Peter. But no one talks about the left side here. No one talks about the drawdowns that you would have had to incur. 66% for NVIDIA, 74% for Tesla, 76% for Netflix, Meta down 77%. There's no right side. There's no upside. Even the S&P 500 has quadrupled on a total return basis in the last decade, but had a big drawdown. We know along the way, the biggest one was in 2020 over this period of time. What's the lesson here for investors?
Yeah, I mean, the lesson is no matter how much you think certain things are getting away from you, certain positions are getting away from you, over the long run, the basket is going to do really well. What's interesting about this chart is everyone does talk about these runaway stocks. And right now, it's these very, very big names, Google, Meta, Apple, and so on. Sometimes what has led the S&P 500 has been Southwest Airlines or Monster Energy. I mean, stocks that have really sometimes surprise people. And it's what's one of the great advantages of owning the market is you always catch that next high flyer. Now, sometimes people say, well, you get Enron too. Well, Enron can only go down 100%, but NVIDIA can go up thousands of percent. Netflix can go up over 1,000%. Same with Microsoft, Tesla, and so on. So you're always catching those high flyers. We're sitting in a world today where there's a lot of concentration in these stocks, but my counter to that is there should be. I mean, we're living in the tech age. We're living in the AI revolution. It makes sense that big tech, where the AI revolution happens to be taking place, should be a disproportionate amount of portfolios. Will these have corrections? Will these get hits? Will these have big drawdowns? As you see in your chart, they've already had massive drawdowns. I mean, Tesla 76% and Google 44% and Meta 77%. And I expect we will see some of these crash and burn, and we will see some of them have massive drawdowns and recover. But as a group, I think the AI revolution will be like the tech revolution. A lot of carnage, a lot of pet.coms, but there are also a lot of companies that wound up running the world that emerged from that. And I think we're going to see that same thing here.
Jack Bogle, don't do something, Peter. Just stand there. So simple, right? So simple. But here are all the things you would have had to confront since 1989 when the S&P 500 total return index started. $1 then is now $40 today, including dividends. 40x your money, but you had to resist that urge of doing something during all of these scary headlines. Seemed like the end of the world many of the times that we're in these things, but somehow the market found a way higher.
If you think about it, if you're a boomer, you really got to participate in the greatest market run ever, right? Like if you're a boomer, you've got these amazing stories about what you paid for your house and what your money in the market wound up being, decades later. Absolutely incredible, but you had to ignore a lot, and most people weren't capable of doing it.
Yeah, and in terms of these bear markets, like in hindsight, it all seems easy, right? In hindsight, but what we're talking about here, Peter, including the 2000 to 2002 bear market, took a long time to recover. 2007 and 2009, a long time to recover. And as you've talked about, at times there's been a decade. I think people today would probably say that's impossible, but there was a decade where the S&P 500 was actually down during that period from 2000 to 2010. And so, like, these things are real. They're a real risk, and they've caused real short-term declines. But the lesson is, if you can stay the course, ultimately every recession has led to an expansion. All of these crises, including the tariff tantrum that we saw early this year, eventually the market looks past it because, as you talked about, all the market cares about is future earnings. And if you expect earnings to be up 20 years from now, very good chance the stock market's going to be up as well. And in terms of why you shouldn't try to get out and time these lows, Peter, you've talked about this, but here's a chart just illustrating when you hit a low in a bear market, it's not an orderly, measured, uh, simple, uh, a few percent move higher. It tends to be explosive, doesn't it? And that makes it much more difficult to kind of pick that low, which many people would want to try to do.
Yeah, a lot of people in a down market go, "Oh gosh, I'm down 30%." Like I remember at the beginning of this year, clients, "Oh, I'm down 20% in my US large cap position. It's going to take me 3 years to get back to even." That's not really how it works. Usually whenever the cloud is lifted, you see a very sharp recovery. 9/11 cocooning effect ends, sharp recovery. COVID, we now know that the mortality rate is much better than had been indicated, instant recovery. Tariff, we see that there's going to be some compromise instead of permanent tariffs in place, instant recovery. So think about it like a roadblock. The second you remove the thing that's blocking the road, the traffic does not take 3 years to get back to where it was. It tends to get back very, very quickly.
Yeah, and just for those listening, not looking at the chart here, it's 36% now off of the lows from earlier this year. So we're not at a full year period yet, and already a huge advance. Jonathan Clements, we got to bring him into the discussion here. And I know a lot of people stay the course is fine, Peter, but some people want to take some action. And what he's saying here, when there's a big decline, he says, I simply take my cues from the magnitude of the market's decline. And the bigger it is, the more enthusiastic I am about buying. And he would often talk about this during bear markets. If he has extra cash or he has an opportunity to rebalance and put more money into the stock market, well, he's going to do it if there's a big decline. And really, the data supports this. The bigger the decline in the market historically, the better your longer term returns are. Do you give
Yes.
permission for people to break that rule of kind of doing nothing and just sitting there if there's a big market decline?
I am a big believer if there's a market decline to deviate a little bit from your allocation, maybe sell off some bonds and get a little more aggressive than you normally would. I am a fan of that. But in general, I like to always be pedal to the metal. Like whatever your allocation should be, as aggressive as it can be, is what it should be all the time.
Okay, and just for those listening again, illustrating here, the biggest S&P 500 drawdown, so bear markets greater than 20%. If you're looking out 20 years from those drawdowns, the average future return was over 1,000%. So a big decline does not tend to mean more declines coming. If you're a long-term investor, you have cash sitting on the sidelines. We talked about that in a recent episode. Well, a big decline is a perfect time if you have a 20-year period to deploy that cash. Okay, let's talk about last chart here. Don't bet against America. We're going to go back to Warren Buffett here, one of my favorite quotes. No one has ever been a success betting against America since 1776, and they're not going to be a success in the future doing it either. And Peter, here's the chart here showing the real return of the US stock market since 1870. So we're looking at over 150 years here. A dollar back then, over 33,000 today. That's real inflation adjusted. So that's about 7% per year above the rate of inflation.
Yeah, I mean, Buffett's point is you've always found a way for there to be economic expansion in the United States. Sometimes people say, well, don't empires fail? And yes, all empires eventually fall, but that doesn't mean their markets fall. So it was before the United States was the global superpower, it was the United Kingdom. And the United Kingdom is no longer the global superpower and continues to fade, unfortunately, and will soon be passed by other countries. But yet their market has continued to thrive, and so you can see that if you've got a somewhat open system, the market is going to find a way.
And how important is that inflationary concept that we're talking about here? Because we know the inflation rate has varied, but really the one constant over time, Peter, is more money is printed. We're going to run more deficits and we're going to have more inflation. So being an owner is really has been in the past and likely will be in the future the best protection against that.
Yeah, you're not going to get anywhere being a lender in a world where Congress and the president don't suffer any real term consequences today for a loose monetary policy, and where the Federal Reserve has no incentive to not print money. I think like you basically have a lot of people making decisions where they can kick the can down the road. And we've just seen that here for decades. And if you're going to be in a world where we're going to see this kind of policy, you're going to have inflation, and inflation is going to be a big factor that drives markets.
All right. Great place to end. Don't bet against America. Definitely not in the long run. And that's 10 charts every investor should frame. Signal or noise. You can find us on YouTube. Hit that subscribe button. We're also on Apple and Spotify. And and I will see you next time on Signal or Noise.